Because even if the market does this over the next 10 years, if you dollar cost average, you're still going to make money. Why? Because you averaged paying this. There are many different types of value investing. I, as a personal investor, have different methods of which I value invest. I have a magic formula method. The magic formula was a little book that beats the market by Joel Greenblatt. I highly recommend you read the book because it talks about buying great quality companies at a cheap price, okay? I do that. I also have a method of buying individual situations where I think a stock might temporarily be lower than it should be because of some sort of issue, okay? So for example, many years ago, I bought BP after the big oil spill because the way I looked at it was the penalty for the oil spill was took off 80 or $100 billion off their market cap, but the penalty was 20 billion and they had the cash in the bank. So I said, okay, this is a disconnect here. It was just people over worrying. I do those. But one of the methods that I've gotten much more into recently has been buying great companies at good prices and hopefully holding them forever. Now, I just read a book called Hunter Bagger, and it was talking about finding companies that can go up 100 times. Now, it's a much easier concept to discuss than it is to actually implement, because in order to find these companies, you have to find smaller companies. Now, so when I say buy great companies at a good price and hold them forever, that's more for larger companies. Things like Microsoft, Apple. And we have several videos. So if you like what I'm going to say in this video, subscribe to the channel and look up our videos about stocks that Paul wants to hold forever. The reason, and I didn't want to put myself in third person there, it's just literally what you should type in, stocks that Paul wants to hold forever. The reason being is companies that can properly manage their cash and either give it back to investors to decrease their invested capital and get a higher return are going to do very, very well for you. In that book, Hunter Baggers, they talked about the soup can theory, where they literally went back in time, bought 30 stocks of the Dow, and held them forever. And at the end of the day, they ended up having today 21 companies through closings, through mergers, through spinoffs, etc. And the returns actually beat the market over that time. Why is that? Well, guys, the thing you have to remember is the more and more you jump in and out of stocks, the worse you're going to do. Investing is one of the few things in the world. Actually, I think a lot of things are like this. Less is more. Spend your time finding good companies that you want and pay a reasonable price for them. Warren Buffett bought Coca-Cola back in 1987, 88, 89, something like that. He paid essentially, it was like $2.30 a share. And in that time, he's collected billions and billions of dividends. Now, his return has only been about 11% a year with dividends, which isn't insane, but it beat the market. And he got a great company that he just realizes, hey, Coke's going to be around for a very, very, very long time. And now it gives him enough dividends every year that I think it pays for over half of his initial investment every single year, just at dividends. He's just going to keep collecting that check, right? So how do you find these companies? Guys, you're in front of them all. Apple, Microsoft, all these amazing companies. Does that mean you just go buy them because they're amazing? No. There are 3 questions I always ask. And this is, if you're new to the channel, you're going to hear me repeat this over and over. If you've heard this before, I still brainwash myself by reading the same things over and over and saying the same things over and over. Why? Because I want them to become permanent fixtures in my brain. The more and more I repeat them, the better and better I will do. It's the same reason why Steph Curry goes to practice and shoots hundreds of threes every single practice. He knows how to shoot a three-pointer, but the more and more he does it, the more and more it becomes automatic. So, first question, do I think this company will be around for the foreseeable future? If the answer is yes, I go to the next question. Now, what's foreseeable future, by the way, to go back to it? 5, 10, 15, 20 years. If you want to hold them forever, it's a company that you'd be shocked if they weren't around 20 years from now. Apple, Microsoft, Google, Ferrari, Louis Vuitton, all these companies. Would you be surprised 20 years from now if they were gone? I think everybody watching would say, yeah, I kind of would be surprised they were gone. I agree. Question number 2. Do I think in the future they will have more revenue and profit than they do today? Okay, very simple question. If the answer is yes to that one, I go to the third and hardest question to answer. Can I pay a reasonable price today for the company that gives me an ample return on my money based on what I project for the future? Now, it's a lot more complicated. Basically, can I pay a reasonable price to give me an above average return? If the answer is yes to that, which is very rare to say yes, but the key is every company at some point will be a yes. You just have to be patient for that yes. That's the key to investing. What we usually have in investing is not investing. We have speculation, and we have this desire to always be doing something. I hold a lot of cash today, and it's people's number one criticism of me. Oh, he holds so much cash. Well, yeah, because I have limited capital. I'm not worth $100 billion. I have to sit there and be very picky with my investments. And I'm talking like, I've had billionaires, literally people on panels say, that's stupid. Well, maybe it is. I get that, but I'd rather sit in cash than overpay for an investment. I'd rather just be patient and wait. And for you out there, I'm not telling you to do that. I've always said since the start of this channel, dollar cost average into low cost ETFs if you're waiting for retirement. Now, I have 8 or 9 businesses. I have hundreds of apartments. I have multiple streams of revenue. I do options. I have an ability to sit there in cash. But when it comes to buying individual companies, if you choose to take a piece of your money, 15 or 20%, and invest in individual companies, I encourage you to sit that money in cash and wait for the right time. That will be key. Find great companies and I do believe you can find great companies at great prices. Is it hard? Absolutely. But when that happens, it's usually because of big panic. It's usually because of stock market crashes or major sell-offs. Think about it. When a crash happens, everyone sells indiscriminately. They don't care what they're selling. They want out. When you buy that ETF, the money goes to the ETF company and they have to buy every company in that ETF no matter what. So the flip side happens when you sell. When you sell that ETF, they have to sell every company in there no matter what. That's what causes companies to fall big time. Look at Apple. Apple recently has seen quite an interesting fall. It was at 180 last year. All-time high is 182.94, exactly a year and 5 days ago. It's currently at 132, and it hit a 52-week low of 124 just recently. So let's go to 1 year, just last week, I think. Yeah, last week, pretty much the 1 year anniversary, it hit a 52-week low, down 33%. If I told you a year ago that Apple would fall 33%, would you really believe that? Look at Google now. Google is a prime example. Go look at our past Google videos. I would tell people what I want to pay for Google, and the all-time high was 152. People said to me, it's not going to hit that price, Paul. It's never going to. I had somebody once write to me, Google will never go below $100 a share. Well, that's awkward. Now, you might sit there and say, well, that's one example. No, there's dozens of examples of stocks we said, don't buy them. And guess what? If Google never went below the price that made sense to us, okay, I just won't buy it. But eventually, even if Google went to $300 a share and the fundamentals made it a $200 company, eventually it would fall below the price that made sense. That might be higher than where it is today, but I'm here to buy based on value, not on price. I don't just look for what's a big drop. What your key is to find the great companies that you love and figure out the price. How do you figure out the price that makes sense? Our stock analyzer tool. This is exactly why the thousands of people in our community use our stock analyzer tool. It allows them to sit there, and let's pull up Google here in my history. So let's just pull up an example of Google right here in my history. I pulled up some assumptions. I assume revenue growth, profit margin for the future. I did a 20-year analysis, some PEs and my desired return. And guess what? I can make the justification for Google today at this price. That's the point. You find the price you want to buy the company at. Now, this stock analyzer tool does not factor in the balance sheet, and it doesn't sit there and say, go out and buy Google right now. Do these assumptions make sense? Is it possible? Yeah, these are all possible. Your goal as an investor is to buy great companies at good prices or great prices. I think $65 a share is a great price for Google. Will we see it? I don't know. But if you told me right now the S&P was going to fall another 40, 50%, we're probably going to see Google at pretty low prices. Why? Guys, when the S&P sells off, Google is a very big part of the S&P. It has to fall much further. It's not going to be immune from the S&P's fall, from the NASDAQ fall. But if you can buy it at lower prices, a great company, you're going to look back and say, 20 years from now and say, boy, I'm really glad I avoided the pain that everybody saw. And I just sat there and said, I'm going to be different. And that's the key to investing. The key to successful investing is buying great companies at great prices and not worry about where the stock is going. If you buy it at 85 and it goes to 70, what do? If you really believe the fundamentals and everything stays the same, you buy more. And that's the difference with investing versus hoping the stock goes up. Because when the stock doesn't go up and you don't know why you bought in the first place, what happens? Look at all those videos in the past where we criticize all those YouTube idiots for Nikola, Neo, Tesla even. Look at Tesla. Tesla was down at one point 75% in the last year. We love Tesla as his cars. We love Elon Musk as a visionary. But we said the stock's too overpriced. It just didn't make sense. Coinbase, all these companies that have fallen, they didn't have the right fundamentals. They're not great companies. We do think Tesla's a great company, but it's not at the right price. Is it getting closer? Absolutely. I'll tell you right now, 104 is a lot better than 414. It's all-time high. But guess what? 104 wasn't good enough for me. But there are some people in our community that think 104 is a great price, and they could very well be correct. And I don't think I can make the argument for 104 a lot better than I can make the argument for 414. But for me, in my position, I'd rather just wait. I want to get it to a point where the entire market has given up on the company. The entire market has given up on all companies. That's where I want to be. I can afford to be that patient. And you can afford to be that patient on a piece of your portfolio. But if you're trying to save for the long run, don't forget, always dollar cost average. You need to get in the habit of always buying the same ETFs. Because even if the market does this over the next 10 years, if you dollar cost average, you're still going to make money. Why? Because you averaged paying this. And that's what matters. And when finally the upswing happens again, and we get another secular bull market of this, your average would have still been this. And you'd have killed it. And that's the point. As you get closer to retirement, your money is going to compound and compound and compound. And that's the goal here. But for that small portion of your portfolio that you use to buy the 15, 20, whatever companies that you, even 10, that you must have, but at great prices, just be patient, subscribe to the channel, subscribe to the software, understand valuing businesses, and go from there. Thanks very much for your time, guys. There are 3 things that you absolutely need in order to be a successful investor: the proper mindset, the proper emotion, and the proper process. Which ones are the most important?